This is Retire Hour.
Welcome into Retire Hour, the weekly show that helps you stay up to date on the ever-changing landscape that is retirement. I'm your host, Matt Goolsby, and you won't want to miss coming up later in the show. We'll have Danny Goolsby coming from our West Wichita office talking about a client story about how they wanted to pay off their mortgage before they actually took the plunge into retirement. And then we'll have Larry Clefcorn talking about tariffs and a potential recession. You won't want to miss that commentary there with advisor Larry Clefcorn. Then after the bottom of the half of the hour, we'll have Corey Hebert in talking about our Medicare Supplement prices. Are they increasing at a higher rate than average? We'll be talking with one of our healthcare advisors about that. And with Alex Robinson with Eidelman Law Firm, we'll be talking about estate planning for people you can't trust with your money. That'd be an interesting story. And then finally, to wrap out the rest of the show, we'll have Joshua Sikora in talking about if you didn't take that amount out of your 401k or IRA, or oftentimes called your RMD or your required minimum distribution, how a 10% penalty might be the best outcome you could be expecting there. You won't want to miss Joshua Sikora and I talk about that at the end of the show. But I wanted to talk about a couple that I met after one of my estate planning classes this week. And as some of you guys know out there, we teach a lot of classes around in the metro areas, whether it's the Kansas City area or the Wichita area. This was a class in Wichita this past week at an estate planning class. And the gentleman came up to me afterwards and he said, I just don't know what my current advisor is charging me. He says 1%, but I just don't know. How do I find out about that? And I had a conversation with, we're going to call him Jim, had a conversation with Jim after this estate planning class and told him about the importance of finding out how much you're being charged. Because as the market's been doing what it's doing, as it's been reacting to the tariffs or the uncertainty of the tariffs and potentially the fact that they won't pass tax reform this summer, the market has been gyrating as it does. But if you're paying a lot in fees, then that's even a bigger drag, or can add to the bigger drag of the market volatility out there. And you don't want to have those high fees drag down your market performance. And had a talk with a gentleman, again, Jim, after this estate planning class. In our folders, we have a fee sheet, and it shows how we bundle all the services around here. But you can actually go to our website at marketadvisorygroup.com, and you can see that fee sheet there and see how we bundle the fees. And depends on what plan we build for you. It might be in a range. We might not be able to get the exact fee down until we build your exact plan. But on the website there, we give the fee ranges. And oftentimes, like I was telling this gentleman at the class this week, if you are working with an advisor, oftentimes if we're not the same price, we can oftentimes be very much cheaper and adding more services and adding ease to your retirement planning, because everything's under one roof around the same table. And he actually found that hard to believe, and I hope to meet him in the next coming weeks. He scheduled an appointment from the class to come in and learn more. But, there's not just people out there that are worried about fees. I spoke with someone that came in from one of the classes this past week. They were worried about the market volatility. And this couple that I met with, she's still working, but she turns 59 and a half as of this weekend. And she said, well, Matt, I've been told that I can roll out money out of my 401k. I can keep contributing to my work 401k, but I want different strategies, and I want you guys to manage the money that I've worked so far to save in retirement, because I'm so uncertain about all this market volatility, and I just don't want another 2007, 2008 to happen where the market drops 40, 50%, and then it changes her retirement timeline. And this is not an uncommon concern that will come across from people, but mostly I find people don't know about the fact you can roll out money out of your 401k when it comes time to you turning 59 and a half. Oftentimes, many employers will let you roll out at least your portion, if not the entire portion, to go be managed elsewhere so that you don't have to change your retirement timeline if there's a big market correction or if there's some kind of market event that will take away the bulk of your portfolio. Like I said, in 2007, 2008, the S&P dropped over 50%. That would change most people's timeline for retirement. So if you're frustrated, or maybe if you're anxious, or maybe you're just uncertain about what's going on in the economy and you don't want it to impact your retirement plan, reach out and give us a call and schedule a 15-minute chat with us, 833-MAG-REPORT. Or again, the number that you can call to schedule that 15-minute just conversation with us from the comfort of your home, your office, your lunch break, wherever. That number is 833, the letters MAG for Market Advisory Group Report. Or you can hop on over to our website at retirehour.com. Or again, to check out that fee schedule, you can go over to marketadvisorygroup.com. Don't be some of the horror stories that I've heard from back, again, long ago during the financial crisis, where if the market has this big correction, it could change the timeline of when you're able to retire, or worse yet, even change the quality of life that you're expecting to have in retirement. You don't need to be hitting these home runs there. I mean, if you want to in retirement, that's great. That's all about your risk profile. But you don't want to be having these massive corrections, again, change or have a negative impact on your retirement plan. And if you want, or if you think you're concerned out there, and if you think it would be beneficial to have a conversation with us, again, schedule that 15-minute chat with us by phone at 833-MAG-REPORT. Or that phone number again is 833, the letters MAG for Market Advisory Group Report. That's our retirement evaluation process, other risks and taxes. That's what report spells out and it stands for. REPORT. That's our retirement evaluation process, other risks and taxes. Well, stay tuned. We're going to pop out to the West office and talk with Danny Goolsby about someone that wanted to pay off their mortgage before they retired. Stay tuned. We'll be right back with more right after this. Welcome back into Retire Hour, the weekly show that helps you stay up to date on the ever-changing landscape that is retirement. And we're going to go out to West Wichita and talk with Danny Goolsby, and an advisor in our West Wichita office there. That's something we've been offering to help clients get help with their retirement a little bit more convenient to where they live on their side of town. Might be having an East office in Wichita. Never know, sometime soon. But we've got Danny Goolsby. You know, you're talking about a story this week of someone that wanted to pay off their mortgage before they retire. But I don't want to steal your thunder, but sometimes paying the taxes, if they take a large withdrawal out of their IRA or 401k, that can be more than the interest on their loan. But tell us about this story about someone that wanted to pay off their mortgage before they retire.
Yeah, so I had a prospect come in to me and talk with me. They were retiring from one of the aircraft plants, and before they retired, they were checking off all of their list of things that they needed to do and wanted to do before they stepped off into the world of retirement. And one of those things was they were really agonizing or wanting to go through mental calisthenics, if you will, on how should they pay off their mortgage, should they not pay off their mortgage, what was the best decision for them. And so we sat down and had a conversation about all the different things that go into that. It's not just as simple as like, well, yeah, I'll pay off my mortgage and check the box. That's over with. There are several things you need to consider. And so we sat down with this individual, the couple actually, and walked them through a process that we talk about. You know, what do they need to look at if they're going to try to pay off their mortgage before they stop away or separate from employment. And so the first topic we come into is, do they need liquidity? So everyone's different that we run into. Some people have what I would say an excess amount of money. They've done a really good job in their adult life accumulating money, investing money, saving money for their retirement. Others are maybe on the other end of the spectrum. They have more of a finite amount of money, and so it's limited. And so the amount of jobs that their money that they've saved in their life, maybe for this second group of people, it needs to do several different other jobs. And so those people who find themselves needing more liquidity, again, if I only have X amount of money in my retirement and I take half of that amount to go pay off my mortgage, or a third of that amount to pay off my mortgage, then all of a sudden now going forward in retirement, it makes those emergencies that come up that much more difficult to say, how am I going to deal with this emergency? Because now I don't have the liquidity. I've used the money in my retirement funds to pay off the mortgage, and that may be something that is beneficial on one respect, but it may take your liquidity away in another respect. So the question number one is, do you need liquidity in retirement, and what's that doing for you if you pay down your mortgage before you retire? The second thing is you need to consider is all right, how do you return, or how do your returns fare that you're investing versus maybe what your mortgage rate would be. Matt, we talk about this all the time with clients. What's your mortgage rate versus what are they getting in the market?
Yeah, I mean, some of those rates out there are 2.9%, 3%, maybe even 4%. You can get almost better than that in a money market, right? I mean, it's sometimes an interesting conversation to see, should you even pay off the house. But taxes, I think, are that biggest consideration there, right?
Yeah, taxes come into a big play. So a lot of people forget about this piece when they just have this thing in front of them that they pay off the mortgage, pay off the mortgage, pay off the mortgage. And again, that's an admirable trait. It's just at what cost are you paying off the mortgage? If you talk about the tax implications, if you're taking it from a qualified retirement plan, which would be more of a traditional 401k or a traditional IRA, those kinds of plans that have never paid the taxes on them, if you're going to go pay off the taxes on your mortgage using retirement dollars, then actually you have to throw the federal and maybe state income tax on top of that. So if you're going to do that, with this couple that we were talking to, I actually went down the hall and pulled in the CPA into the conversation and said, hey, we need to have this conversation from a tax standpoint. What would be the effect? This gentleman had brought in his tax returns. And so we were looking at what his tax returns from last year. And one of our CPAs was having a conversation with him saying, all right, well, this would be the implication on you. If everything stayed like it was, then this is how much you're going to have to withhold in addition to your mortgage amount from your retirement savings, which again, just magnifies how much you have to take and draw down your retirement plan. The short of that is that you're making, if you were to do this, if this couple were to do this, they would have just that much less money to survive for the rest of their lives. Again, it just makes it tough. A couple other things is that you need to look at is a lot of times people will say, okay, I would just like to have some peace of mind. I just want to pay that off. It's just that burden. It's just been this thing. It's been over my head for all this life. And I think I'll have a better retirement. And some of this conversation, I think, gets at the heart of will I have enough money in retirement? And so they think that they're going to pay off their mortgage, and that's going to help them in will I have enough? Matt, you're shaking your head. Would you have comments that way?
Well, I mean, it's just the same scenario where you had this with a married couple. I had it with someone that's single. Let's call her June. She wanted to take $100,000 out of her IRA. And I said, well, to get $100,000 out of your IRA, you're going to need to take about $130,000. But let me go have a tax advisor crunch those numbers. And between the conversation and this is a phone call she called in, by the time I hung up with her to go down and find from the tax advisor how much in taxes June would owe, just because her monthly payment had gone up a couple $100. And I said, well, are you an adjustable rate mortgage, or is this just your homeowners and your property tax going up? And she said, well, I'm on a fixed rate, so this must be my homeowners insurance and my property tax. Well, paying off your house, you're still not going to get rid of those, right? Those are still going to go up every year. Between the phone call,
that part,
right? Between the phone call of asking for the withdrawal and me going down and which took about 10 minutes to go talk to the tax advisor and figure out what the taxes are, June decided, you know what, I'm not going to take that withdrawal out. Just start sending me an extra couple $100 a month to make sure I can make this payment.
Right. So just make sure that you have this conversation. Walk all the way through it with someone from a tax standpoint, making sure you're covering all of these aspects before you do that.
Yeah, and so many people do forget about the tax aspects, and I get that. Whatever you've saved for in your retirement, you look at it out there and you go, oh, I've got $1 million. Well, if you take that $1 million out all at once, you might end up with $600,000. You have to remember the tax consequences. And furthermore, you need to ask someone that can give you tax advice, is it a right move? And if you don't have someone that you can go to, ask yourself, how do you know you're making the best decision for yourself if you haven't factored in the tax advice before you engage that withdrawal? And if you don't have someone that can help you walk through all those consequences of taking those larger withdrawals, reach out and schedule a 15-minute conversation with us at 833-MAG-REPORT. During that 15-minute conversation, you can tell us some of your concerns and what maybe some of the issues that are top of your mind, and we can tell you if you could benefit from coming in and going through our full-blown process, or maybe it's just a quick answer to the question that you've had for a long time, and it would help you move forward with your plan in retirement. That phone number again is 833-MAG-REPORT, or again, 833, the letters MAG for Market Advisory Group Report, or you can hop on over to that website at retirehour.com. Well, stay tuned. We'll be right back with Larry Clefcorn talking about where do we stand with tariffs and this potential recession. Stay tuned. We'll be right back with more. So welcome back into Retire Hour, the weekly show that helps you stay up to date on the ever-changing landscape that is retirement. And I've got this dad joke I've been using lately, and it's about the only thing you can do is laugh at all this that's going on. I've been telling people that have come in that the markets are tariff-fied. Yeah, there's that slapping the knee there, right?
Love that.
Yeah.
Love that.
So we've got Larry Clefcorn here to talk about where do we stand with the tariffs and the recession, and maybe let's throw in tax laws or sunsetting at the end of this year. There's a lot going on this year.
There is, and people are concerned on different levels, and so I've been doing some client reviews in here because we preach this thing that if your financial advisor has not sat down with you and gone over how you're positioned, you need to be on him.
No
need
kidding.
to be calling him.
No kidding.
And so, we practice what we preach around here. And so, working through this with a number of clients, one in particular was very concerned. He felt that this is never going to end. This is going to go on for 4 years at least.
Quite possible.
And, he was battling with himself, you might say, in terms of, should I go really, really conservative, like money market conservative, or where should I be exactly? And his concerns are well-founded. I heard this report over the weekend is that our Treasury Secretary, who is conducting a lot of the negotiations, President Trump can't do them all.
Yeah, he can't be everywhere.
Yeah. So the Treasury Secretary had been telling people on Wall Street that, they're close to agreements and making a deal, but yet nothing is being announced, and that's making the market jittery.
Sure. Well, you think about this. Right now, our government's probably moving a little faster than the rest of the world governments, and government's never infamous about being quick about much. And if you're working with all these other governments, they can't just probably snap their fingers and get something done. And there's probably, again, like you said, some negotiating going on there. But it would be helpful if one of those deals got released, right?
It would be, and that's kind of what they're looking for is because these first ones that he's working on are with friendly nations. Some of them are considered our really close allies, and so for this reason, I think. And I was able to talk to this client and go through and tell them what each piece is doing and and one of the things that I hear myself continue to tell people is, can you see the multi-levels of risk management that's built in here? And they said, that must be why it's holding up so well. And I said, exactly. It's because we don't just have you set up where you're just in one category. We've got several different levels here, and if we need to adjust any one of them or all of them, we can do that.
Yeah, you're actually reminding me of, this was a couple weeks back when all this started. I think it was around Liberation Day or April 2nd. Had a gentleman who he was here and he's moved up north. He doesn't live in the surrounding area anymore. We work virtually. He sent me an email and said, am I going to have any money left after this 4 years? And I started looking at his accounts and kind of seeing what's going on. And I said, well, Greg, the market, the S&P 500 was down at that point like 12, 13, 14%. Greg was down about 2.5%. And I said, for comparison's sake here, Greg, you've taken a larger withdrawal earlier at the beginning of this year than you've been down from market volatility. And he goes, oh, well, when you put it that way, maybe I just need to turn off the TV. And I said, well, no, I think you did the right thing, Greg. You reached out to us to see what's going on in your situation.
Right.
But it assuaged his fears, his concern, his rampant anxiety from just watching the TV and watching all the red. And if you don't have a plan, I can see how people would get uncomfortable, and
Right.
they just need to be reminded of their plan that's at work for them.
They do, and like we say, if we need to tweak it, or I used to say this a lot more than I have lately. I don't know why that is, but we need to be nimble. You know, you've heard me say that for quite some time, just not so much lately, because I guess when we're implementing this multi-level risk management, that kind of serves that entire purpose, is that we can make those adjustments. We can go either left or we can go to the right side of the risk spectrum and make people feel better. So this client in particular, they were so relieved walking out, because just putting their eyes on their entire financial plan gave them a peace of mind that that the worst has not already happened to their portfolio.
And you've got some people out there that are sometimes even scared to look at their accounts. But if they're within, call it that 5 minute, they're telling me in my ear 2 minutes. If you're within that 5-year window, where you often refer to as the retirement red zone of retiring, that's probably not a great strategy of just sticking your head in the sand and not looking at it.
Oh, that's right. You've got to be paying attention and make sure that you have an advisor who is receptive to, I started to say your plight.
Well, or your situation. But if you guys are thinking out there, man, I need to get things straightened out. I need to quit ignoring this. I need to quit just sticking my head in the sand. If you don't have a plan, reach out and have a 15-minute conversation with us at 833-MAG-REPORT. That phone number again is 833, the letters MAG for Market Advisory Group Report. Or you can hop on over to our website at retirehour.com or marketadvisorgroup.com. Again, that 15-minute conversation, what's that commercial? 5 minutes could save you 15%. I'm not saying 5 minutes could save you 15%. That's a different company. But you want to have that 15-minute conversation with us just to make sure you don't have any unexpected surprises that could be lurking out there in your retirement plan, or worse yet, have a mistake that could cost you thousands or cost you dearly on your retirement timeline. Well, stay tuned. We'll be right back with Corey Hebert talking about, are you seeing those Medicare supplement prices increasing? Is that higher than average? Stay tuned. We'll be right back with more right after this. Welcome back into Retire Hour, the weekly show that helps you stay up to date on the ever-changing landscape that is retirement. And maybe I haven't talked about this in a while. I'm a financial advisor, and the people I help in retirement, they come to me all the time with all kinds of questions. Some of them are in my lane on their investments, when to maybe start Social Security and where their income's going to come from to supplement their Social Security in retirement. But then I get other questions like, well, how much in taxes should I withhold from this withdrawal? Or is this going to cost me more in taxes? Should I just keep paying on my mortgage? Sometimes it's a question of, do I need a will? Do I need a trust? Matt, we come from a blended family. We have kids from previous marriages. How do we make sure we have an estate plan that can transfer this all? These are so many questions that I get all the time, but probably the question I get the most is often about Medicare stuff. And I can spell Medicare. And I joke about that. I mean, because I interview you guys every week, I learn a little bit more than the average advisor. But Medicare's its own can of worms. Medicare's its own monster under the bed, so to speak. I mean, things change here. There's Medicare Advantage. There's Medicare Supplement. If you have TRICARE, if you are on government insurance, there's all these little nuances. But one of the ones that you're going to talk to us about this week is, are Medicare Supplement prices rising at a higher than average rate? Is this something that maybe someone asked you in one of your reviews? Because I've not gotten this question, so I'm interested to learn more about what's going on here.
Yeah, Matt. So it's something that we're seeing come up a little bit more frequently with a lot of our clients that we currently have. And we get communications from insurance carriers whenever things are typically happening or going on. And just earlier last week, I got an email from one of our insurance carriers, and it's one that I hate to see. They had announced their annual price increases that were coming with their plans. And on that email, normally I look at that and I expect, it's the annual 5-6%, whatever it may be. I saw the terrible number of 25%.
That's a big jump.
And I know you noticed this recently. I just started wearing glasses around the office. I had to wipe them off, double check. Was that 2 actually there? Was it 2.25%?
I thought you were just wearing the glasses to make us all maybe think you're smarter. Maybe, so they're real? Those are real? Okay. So anyway, back to your story. So
But
it was a
25%
That's
jump.
a big jump.
Yeah, absolutely. And one of the things that we talk about whenever we sit down with a client, we prepare them that we might ask them some questions that people haven't asked them before. We always get into, of course, the health stuff. Who's your doctor? What kind of healthcare needs do you have? We also talk a lot about budget and longevity. We get into the question of, hey, this is always going to be tough to talk about, but are your parents still with us? How young were they when they passed away? To try to start age dating a client, because we want to make sure that reasonably we build in the cost of healthcare going up to make sure that they're able to pay for their healthcare while they are still young, healthy, able to need it. And 25% jump is not something that's super easy to factor in to somebody's healthcare decisions.
No, and so out of curiosity about this specific case, was this someone that could go through underwriting and maybe look at other companies? Because sometimes if you can, just like you can save money on sometimes on your car or home insurance, you can go out there and save money on your Medicare insurance, and you don't have to wait till open enrollment. I have learned that much about Medicare supplements. But if you can answer some health questions, this is something that person can maybe go shop their coverage and maybe see. But if they have some things going on with their health, sometimes they've got to stick with the company where they're at.
Yeah, Matt, you're exactly right with that. And with this case, there were, of course, after I get that email, there are several people that called down. One of them calls down, this doesn't go into effect for 3 months. Is there anything we can do in the time being? And this gentleman just so happened to be still in excellent health. And that's just as easy as, let me get you right on the line with my secretary. She's going to get you on my calendar. And then we'll go through that process of underwriting, which is going to be 25 to 35 different health questions.
And this is something that they don't have to wait until, again, open enrollment. On
Nope.
Medicare Supplement, you can do year-round.
We can do this any day of the week, any time of the year. And Matt, I'm really glad you brought something up there just a moment ago, that you can change from one supplement to another, and you have to do it whenever you're healthy. This is something that oftentimes will go overlooked in the Medicare system. If somebody has a Medicare Advantage plan, and they want or think that eventually they're going to want the Medicare supplement, they can also underwrite from Advantage to the Medicare supplement plan any day of the week, any time of the year. And it's very important. I hear this all the time. Corey, I'm 65, I'm young, I'm healthy. I don't need to pay for the supplement now, but I think I might want to in the future. That's a good mindset, good attitude. The only problem is, when are you going to want to start paying for that Medicare supplement? Probably as soon as your health takes a downturn. So it's important that if that's the direction you want to go somewhere in the future, you're conscious that nobody's getting any younger around here, and we go through that underwriting process while underwriting is still an option.
Well, and I see over on the long-term care side, I'll sometimes see people that don't want a long-term care policy until they have something that's going on in their health that's a little debilitating, but sometimes then they cannot get that long-term care policy because they've waited until they have some things going on. But I want to circle back around to, you just taught me again something new. So if you want to go Medicare Advantage to Medicare Supplement, you don't have to be in open enrollment. You don't have to be in that October 15th to December 7th window. But if you want to go Medicare Supplement to a Medicare Advantage, you do have to be in on the open enrollment window.
Yeah, absolutely. That's right. And Matt, don't want to make you feel bad about this. You and I talk about Medicare all the time, and you said a little bit earlier that you're more apt than the average advisor. I 100% agree with that statement. This is a confusing system, bouncing from one to another, and this is not something that realistically I would expect you to know, that I would expect a client to know, that I would expect anybody but somebody who does Medicare day in and day out to have an understanding of how can I navigate and move through these plans.
And it stays the same forever. It never changes, right? That's sarcasm, by the way. It changes all the time. And that's why you guys, again, have your own department, because you guys can stay up on this and as it changes. And if you guys don't have someone helping you navigate the changes and the things that could be going on, let alone in your situation, or just as the overall rules or the programs change, reach out and have a 15-minute conversation with us at 833-MAG-REPORT. Or again, that phone number is 833, the letters MAG for Market Advisory Group Report. That report stands for our Retirement Evaluation Process, Other Risks and Taxes, REPORT. If you don't have access to a phone right now and you're driving, you can always go to that website at retirehour.com when you're not driving, or marketadvisorygroup.com. Well, stay tuned. We'll be right back with Alex Robinson talking about estate planning for people that you can't trust with your money. Stay tuned. You won't want to miss this. We'll be back. Welcome back into Retire Hour. I have an estate planning joke that I'll tell at the estate planning class, and it doesn't get a lot of laughs, so it must not be that funny. So I'm going to try it here, and then this is probably where it goes to die, no pun intended. Estate planning, you won't be here when the majority of your estate plan kicks in, so make sure you have it right?
That's correct.
So, again, that just kind of, I don't know if that doesn't play well, or maybe, can you avoid probate? No, you'll be dead.
Right.
So but you want your loved ones to avoid probate, and let alone there's other things out there that can hurt your loved ones. And you have a story about someone that really, they didn't have the right plan in place, and there was some horror stories with as far as their beneficiaries and the money that went to them. Tell us what's going on here, Alex.
Yeah, I had a client who left probably $1.5 million to their kids. They had a bunch of kids. Each kid got like a $250,000 a piece. And we had a meeting because they weren't my client to begin with. Someone else had drafted the plan and done everything. And we sat down together, and one of the beneficiaries turned and looked at me, and with no irony and no completely serious, said, $250,000 sure goes by quick. And I had to be like, So hang on, they'd already pretty much spent it.
Yeah, and this was like 3 months after their mom had died.
So they were left almost $250,000, and mama passed away, and the average inheritance we talk about is gone in 90 to 120 days. So they were certainly on average there, right?
Yeah, and it was unfortunate because they were in a hole. They'd bought a fancy car, and there's a lot of upkeep on that, and they'd moved into a new house, and they're like, oh, wait a second, we didn't really take into consideration how much our insurance is going to jump up, and taxes and everything else. And in a way, they're worse off afterwards than they were prior to their mom passing.
So this is what you're saying when you need some kind of estate plan for people that you can't trust with, not necessarily your money, but that's how you typed it, your money, but that you can't trust with money in general. They can hurt themselves in a way. And so there's different strategies, or there's different techniques that one can engage. It just depends on really what the objectives are someone's trying to reach here.
Yeah, that's 100% right. Is what is your objective? We have clients whose beneficiaries, who their kids are serial entrepreneurs, and if you give them $1 million when you die, they're going to make the best business of all time with that $1 million. But then if it fails, they have nothing left, and or they spend money as soon as it comes in, or they have an addiction problem, or they have a spouse that has any one of those conditions, and they're susceptible to the spouse being like, hey, we need to go on this big cruise or whatever it is. And so we can draft a plan that fits for you and that helps protect your family and the unique situations that your family has that no one else has.
You know, you said someone might be planning a big cruise. I'm thinking $250,000 cruise. I don't think those exist. Actually, I do think those exist. Those are those world cruises
Right,
where
yeah.
you're there for months and months. So you're right. I think Gerald, our lead estate planning attorney, he will often refer to these kids as creative spenders. And I think that's a very polite way to say it, but a creative spender, like you said with your opening story, money can go quick, especially with people that are not used to it.
And I think that's a huge part of it, is that our brains trick us into, we get a check or we get, a distribution, and it's 6 figures, and we've never seen that before. And our brain says, I can never spend all of this money. There's so much money, I'll have it forever.
Or I'm rich. Oh no.
and the average professional athlete is either bankrupt or in financial trouble 3 years after retirement. And so that money does go quickly. And unless there's a plan in place, kids are going to spend it. That's just what we've seen.
And there can be different tools out there where you can either control the spending from beyond the grave, is what we'll talk about, or you can string it out in an income stream so that they don't get it all at once and they spend it all at once. Of course, sometimes people, when they know the income stream's coming, if they can figure out how to spend $1, they can go figure out how to spend $2 with that dollar and get themselves into debt. But there's a lot of different tools out there and strategies for people that need to either protect their kids from a spouse. Like you said, sometimes it's not always the kid or the beneficiary that's going to get in trouble. Maybe they're married to someone that's going to encourage them to spend that in frivolous ways and go through that pretty quickly. So was this done on purpose? Because when you wrote in your headline here for the show, estate planning for people that you can't trust with your money, is a trust kind of where you're leaning towards that helps fix a lot of these situations?
Yeah. So a will is, I think of it as fire and forget. You can just say who gets what, and that's kind of the end of it. With the trust, that's one of the main benefits of a trust, is the ability to time out distributions or to otherwise control it. So we can do things like a third. So a third at the death of the last person to die, a third a couple of years later, and that last third later on. Because what we find most of the time is someone blows that first third, and then that feels bad. They're like, oh, I didn't enjoy that as much as I thought I would. And those second distributions later on down the road, they make a lot better decisions with it because they're like, okay, now I know what that feels like. I want to do something different this time around.
Well, I think that's what we all hope. But sometimes people are just like, I'm going to blow this third, and then I've got 6 months or a year to blow another third, and that happens.
And if that's what you think will happen, then we have different things that we can do. So we can do what's called a HIM standard, health, education, maintenance, and support, where a trustee holds that money. They don't get distributions outright. They get distributions when they need something, and they have to come to the trustee and say, hey, I need to go back to school to get a better degree or whatever it is.
And what's so beneficial about this is I get to know the client. I have this relationship. I bring you into the mix, and then we can continue this conversation. Whereas how it works out there, if you're not working with someone as a team, you've got to restart that conversation as the individual. You've got to make sure you relay all your situation to the attorney, and you have to be the middleman between the attorney and the financial advisor. And that just leaves a lot of room for things to fall through the cracks, or maybe even to drop the ball, or worse yet, just to procrastinate and put it off forever. And if you don't have someone that's helping you navigate all these complicated issues in retirement, reach out and schedule a 15-minute chat with us by phone at 833-MAG-REPORT. Or that phone number again is 833, the letters MAG for Market Advisory Group Report. That report stands for our retirement evaluation process, other risks, and taxes. And if you don't have an estate plan that's working for your situation, that is by far another risk that you're not addressing, and you need to soon. Well, stay tuned. We'll be right back with Joshua Sikora, our lead tax advisor, talking about if you missed that required minimum distribution amount, a 10% penalty might be the best outcome you can expect. Stay tuned. You won't want to miss this. Welcome back into Retire Hour, the weekly show that helps you stay up to date on the ever-changing landscape that is retirement. And I'm your host, Matt Goolsby, and we're joined with Joshua Sikora here for our last segment of the show. we're talking taxes, and I can't tell if I'm always excited to get this point because the show's about over with, or if I'm just always so excited to talk about taxes.
Or you're just ready to slip out of the booth for a little bit.
So now this is, I think you're again teaching me something here, which that's not uncommon. I know with the Secure Act changed the penalty from, if you didn't take out the amount you were supposed to take out from your IRA, your 401k, when you turned 70 and a half, 72, 73, 75, whatever the RMD age is now, because it's depends on when you're born.
Yep.
I know the penalty was 50%, as in 50, and then I know that Secure Act changed it down to 25.
Yep.
But you're talking about a 10% penalty might be the best outcome. I'm not familiar with the 10% penalty. What's going on here?
Yeah. So like you said, from time immemorial, it was a 50% penalty if you missed an RMD, required minimum distribution. And then with the Secure Act, they said, you know what? We're the kindler, gentler IRS. We'll just make it 25%. But if you fix it, if you take that corrective distribution, we'll cut you a deal and make it only a 10% penalty.
But then you owe income taxes on top of that.
That's
too.
right. But when you take the money out, you're paying the income taxes anyway.
Okay. Well, I guess where my brain goes is if you're having to make up for that shortfall, well, normally you have to take out another RMD that year, so you're just again pushing yourself up higher the tax brackets. So.
Yeah. So this really came out from a client we're working with who does not work with one of the advisors here. They have a separate advisor. They came in to do their taxes, and they said, "Hey, we missed our required distribution last year, so we took it out in 24." Okay, fine. So they pay taxes on it because they took it out. And because they took it out, they then qualify for paying only the 10% penalty instead of the 25%. Now, for a lot of people, the 10% plus, another, let's say they're in a 12% bracket, that's only 22%. That's still better than the 25% penalty, right? But in order to get that special 10% penalty, that 15% off coupon, so to speak, you have to file an amended return.
Okay.
So not only do you have to pay the penalty, but you also then have to pay for that amendment, unless you're, using your big box software to do it yourself. And good luck, because, this is a more complicated thing than just filing your taxes.
Well, this is, again, a classic example, and I might add this to our tax class because this is a pretty good example. If you're having all these people helping you in retirement, you having the tax person, you have your financial advisor, maybe you have your estate planning attorney and your healthcare or Medicare advisor. But if you're not working with them together, it's your responsibility to relay all the information between them. And it sounds like the financial advisor and the tax person, that's you, and the financial advisor's not one of us.
Yep.
That's the risk you run of working with all this disconjointed. It's your responsibility.
And so that's when we have these tax planning conversations with our mutual clients in the fourth quarter. One of the things we talk about is maybe for because they have the required distributions, we're not talking about Roth conversions anymore. That's often how it works. But we'll still talk about a withholdings review. Is your return going to come out where you expect it to? And in that, we're going to still put together that plan of what your income is going to look like, where we say, hey, you're 73 now or more. You have these required distributions. Let's get those in that income plan. Hey, Matt, Danny, Larry, Jonathan, have those RMDs come out yet? And then you'll say, yeah, they're out. They came out a while ago. Or, oh no, we better make a plan to get those out. Do you want to talk about doing some charitable giving with that? What do we want in terms of withholdings? That plan is where we all come together and make sure that everything's coming out before the year closes out, like it should be, to prevent you to need that 15% off the penalty coupon.
So this is someone that didn't get to take their full amount out that's required by IRS, and they're looking at a penalty here. Do you have approximately what this is going to cost them in extra taxes? I mean, you might not have came with that.
Let's say the taxes are going to be the same. Because they are, I'd have to back into
in the same brackets, yeah. Sorry,
if they're in the same brackets, the taxes will be about the same. I know by amending the return to get the 10% off or the 15% less penalty, I think it's saving them like $1,200 by doing all that work.
But it probably cost them an extra $1,000 then if they're saving about 15% of $12,000.
Yeah, thereabouts. So it's still expensive.
And that was just because, again, the system's broken, in my opinion, and everyone's not talking together, and it's the client or the retiree's responsibility to relay all this information between the tax person and the financial advisor. And that just, oftentimes I find people that want to do it that way, they're maybe the do-it-yourselfers, but sometimes, worse yet, maybe they don't know any different. that's really the ones that I feel sorry for.
That's right. When there's a better way to do it, it's just, you have to ask questions. You have to make a 15-minute call.
What a great segue for that. So if you don't have a team that's helping you with your retirement and you're wondering what you could be missing, reach out and schedule that 15-minute call at 833-MAG-REPORT. Or that phone number again is 833, the letters MAG for Market Advisory Group Report. Or you can go over to the website at retirehour.com or marketadvisorygroup.com. You know, you say that phone number, Joshua, like you've almost hosted the show a couple times. Should I just give it to you and let you do it all the time?
No. You've got it all queued up.
I don't know. I mean,
I didn't bring that energy to the table today.
Well, it sounds like you did. So, no, but thanks for hosting the show while I've been on vacation and out of the office for some conferences. That's all the time we have this week for Retire Hour. Don't forget to check out our other shows, Eye on Retirement or Health and Retirement as well. You can do that by checking out YouTube at retirementhelp.com or going over to the website at retirementhelp.com. We thank you for tuning in this week. Don't forget to check out, like I said, our other shows, and we'll be right back next week. With Retire Hour. See you guys.
Unless otherwise indicated, all client names have been changed to protect their identities. Investment advisory services are offered through Foundations Investment Advisors LLC, an SEC-registered investment advisor. The content provided is intended for informational and educational purposes only. The views, statements, and opinions expressed herein are those of the individual speakers and not necessarily those of Foundations and its affiliates. The information contained herein does not constitute an offer to sell any securities or represent an express or implied opinion or endorsement of any specific investment opportunity, offering, or issuer. Any discussion of performance or returns are not indicative of future results. Each individual investor situation is different, and any ideas provided may not be appropriate for your particular circumstances. Foundations only transacts business in the states where it is registered or excluded or exempt from registration requirements. Registration as an investment advisor is not an endorsement of the firm by security regulators and does not mean the advisor has achieved a specific level of skill or ability. No legal or tax advice is provided. Always consult with a tax professional. Legal services are offered by Edelman Law Firm. Tax services offered by Market Tax Services. Market Advisory Group does not provide legal or tax advice. Any comments regarding safe and secure investments and guaranteed income streams refer only to fixed insurance products. They do not in any way refer to investment advisory products. Rates and guarantees provided by insurance products and annuities are subject to the financial strength of the issuing insurance company, not guaranteed by any bank or the FDIC. The guest commentators featured in this show are not investment advisor representatives of Foundations and do not provide advisory services. Market Advisory Group does have several investment advisor representatives that can provide such services. This is not endorsed or affiliated with any U.S. government agency, the Social Security Administration, or associated with any federal Medicare program. We do not offer every plan available in your area. Any information we provide is limited to those plans we do offer in your area. Please contact Medicare.gov or 1-800-MEDICARE to get information on all of your options. A Roth conversion may not be suitable for your situation. The primary goal in converting retirement assets into a Roth IRA is to reduce the future tax liability on the distributions you take in retirement or on the distributions of your beneficiaries. The information provided is to help you determine whether or not a Roth IRA conversion may be appropriate for your particular circumstances. Please review your retirement savings, tax, and legacy planning strategies with your legal/tax advisor to be sure a Roth IRA conversion fits into your planning strategies. All rights reserved.